The global financial system is not a natural phenomenon. It is a carefully engineered machine designed to facilitate the exchange of labor for a medium that the central bank can expand or contract at will. For the last 15 years, that machine has been set to one specific mode: infinite expansion. Since the great financial crisis of 2008, the world has operated under a single, unspoken assumption. That assumption was that money is essentially free, and debt is a problem for someone else to solve in the distant future. But on a quiet Tuesday, in early 2026, that assumption was dismantled. Donald Trump's confirmation of Kevin Warsh as the next chair of the Federal Reserve is not just a political appointment. It is a declaration of war against the era of easy money. While mainstream media outlets are busy analyzing the political loyalty of the pick, they are completely missing the systemic reset that is now in motion. The immediate reaction was a violent liquidation in the gold and silver markets. To the uneducated observer, this looked like a panic sell-off based on the fear of a stronger dollar. But to those who understand the plumbing of the global financial system, it was something far more cynical. It was a coordinated flush of the retail market, executed by the very institutions that manage the supply of paper assets. Kevin Warsh is not a typical bureaucrat. He is a systemic architect who believes that the Federal Reserve has become a source of moral hazard. He has spent over a decade arguing that the Fed has distorted the price of everything from real estate to government bonds, creating a world where risk has no price and debt has no consequence. By nominating Warsh, Trump is signaling that the promotion is over. The safety net that has protected Wall Street for 20 years is being removed. And for the first time in a generation, the markets will be allowed to fail. This is the Kevin Warsh factor. It is the sudden and brutal return to reality for a world that has been living in a monetary hallucination. To understand why the markets are terrified, you have to look at the track record of Kevin Warsh. He is the ultimate insider. At 35, he was the youngest governor in the history of the Federal Reserve. He began his career at Morgan Stanley, where he worked in the department that handles mergers and acquisitions. He does not view the economy through the lens of social justice or employment statistics. He views it through the lens of a balance sheet. During his previous tenure at the Fed, Warsh was often the lone voice of dissent. In 2010, while his colleagues were cheering for the first rounds of quantitative easing, Warsh was writing memos, warning that the Fed was overstepping its bounds. He argued that by printing trillions of dollars to buy government debt, the Fed was effectively turning the United States into a centrally planned economy. He warned that this would lead to a massive misallocation of capital and the eventual destruction of the middle class through hidden inflation. For 15 years, he was ignored. The Fed continued to print. Interest rates stayed near zero, and the stock market reached heights that had no basis in economic reality. But now, the cycle has turned. Trump has realized that to survive the next decade of global competition, the United States needs a currency that is actually worth something. He needs a hawk who is willing to do the dirty work of cleaning up the balance sheet. Warsh is often compared to Paul Volcker, the legendary Fed chair who crushed inflation in the 1980s by raising interest rates to 20%. While Warsh might not go that far, his philosophy is the same. The pain is a necessary part of the cure. He believes that the system needs a purge. He believes that zombie companies, which only stay alive because of cheap debt, should be allowed to go bankrupt. He believes that the stock market should reflect the health of the economy, not the speed of the printing press. This is why the market sell-off started the moment his name was confirmed. Wall Street realizes that the man who understands their secrets is now the man who controls their supply of oxygen. One of the most confusing parts of the Warsh nomination was the sudden collapse of gold and silver. According to every textbook in finance, if you appoint a hawk who is going to make the economy more volatile and the debt more expensive, people should run toward the safety of precious metals. But instead, we saw a record-breaking drop in prices. Why? The answer lies in the difference between paper gold and physical gold. Most people who think they own gold actually own a digital contract on an exchange like the COMEX. These contracts are traded with massive amounts of leverage. For every $1 of their own money, traders might borrow $20 or $30 from the exchange to bet on the price of gold. According to data from the CME Group, the moment the Kevin Warsh news hit the terminals, the requirements for this leverage, known as margin requirements, were suddenly increased. This was not an accident. When you raise the margin requirement, you force every trader who doesn't have a huge pile of cash to sell their position immediately. This creates a forced liquidation. As these traders sell, the price drops. As the price drops, it triggers the stop-loss orders of other traders, which forces even more selling. In a matter of minutes, a healthy market can be turned into a slaughterhouse. According to the London Bullion Market Association, while the paper price was crashing, the demand for actual, physical gold remained at historic highs. Central banks in China, Russia, and the Middle East were not selling. They were buying. They were using the low paper price created by the margin trap to accumulate more physical metal at a discount. The big banks, such as JP Morgan and HSBC, are the primary market makers in this space. They understand exactly how much leverage the retail public is using. They use news events like the Warsh nomination as a catalyst to trigger these liquidations. They are not losing money on the gold crash. They are harvesting the wealth of the people who were too slow to realize that the rules of the game had been changed. There is a massive contradiction that has the pundits confused. Donald Trump has spent the last 8 years complaining that the US dollar is too strong. He believes a strong dollar makes American exports too expensive and hurts the manufacturing base. So why would he pick Kevin Warsh, a man whose policies will almost certainly push the dollar to record highs? The answer is a strategy known as financial mercantilism. Trump has realized that in the current global environment, the dollar is not just a currency, it is a weapon of economic warfare. By appointing a hawk like Warsh, Trump is signaling to the rest of the world that the era of the US subsidizing global growth with cheap dollars is over. According to reports from the International Monetary Fund, there is currently over $13 trillion in dollar-denominated debt held outside of the United States. When the Fed raises interest rates or shrinks its balance sheet, the supply of dollars in the global market disappears. This is what economists call a liquidity squeeze. For countries like China or the members of the BRICS nations, a stronger dollar is a nightmare. It makes their debt more expensive and their own currencies weaker. Trump is using Kevin Warsh to put a stranglehold on the global financial system. He is forcing every other nation to either come to the negotiating table or watch their own economies collapse under the weight of a rising dollar. This is the hidden genius, or the hidden danger, of the Warsh pick. Trump is willing to accept some pain in the US stock market if it means he can achieve total dominance over the global monetary order. He is betting that the American economy, while fragile, is still more resilient than the rest of the world. He is using Warsh as a financial nuclear deterrent. He is telling the world, if you don't play by our rules, we will make your money worthless and your debt impossible to pay back. For the last 2 decades, the most important concept in investing was the Fed put. This was the belief that the Federal Reserve would always step in to save the markets if they dropped by more than 10 or 15%. It was the guarantee that kept the bubble growing. Investors were happy to take massive risks because they knew that at the end of the day, Jerome Powell or Janet Yellen would print enough money to bail them out. Kevin Warsh has built his entire intellectual reputation on destroying the Fed put. In his public speeches and op-eds, he has argued that the central bank should not be an insurance policy for Wall Street. He believes that if a bank makes a bad bet, it should go bankrupt. If a tech company has no profits and too much debt, it should be allowed to fail. This is a terrifying prospect for a generation of investors who have never seen a real bear market. According to The Street, Louis Fed, the current valuation of the US stock market is heavily dependent on the expectation of future interest rate cuts. If Warsh refuses to cut rates, even when the market is screaming for help, the entire structure of the modern financial system will begin to buckle. Think of the economy like a forest that has not had a fire in 50 years. Because the Fed has suppressed every small crisis, the amount of dry underbrush or bad debt has reached a critical level. Warsh believes that the only way to save the forest is to let it burn. He is willing to oversee a massive correction if it means returning the market to a state of honesty. The systemic rot is now so deep that any attempt to return to sound money will feel like a depression. We have become so addicted to the drug of cheap credit that the withdrawal process will be violent. Warsh is the doctor who has been hired to oversee the detox, and he is not interested in your comfort. When you look at the stock market, you are looking at the surface of the ocean. To see the monsters, you have to go deeper into the shadow banking system and the repo market. This is where the world's largest financial institutions trade trillions of dollars in short-term loans every single night. According to data from the New York Fed, the repo market is the actual heart of the global economy. It is where banks use government bonds as collateral to get the cash they need to keep their operations running. For years, the Fed has been the primary provider of liquidity in this market, acting as the lender of last resort. Kevin Warsh wants the Fed to exit this market. He believes that private banks should be responsible for their own liquidity, and that the government should not be subsidizing the gambling habits of hedge funds. But there is a major problem. The shadow banking system is now so large and so interconnected that no one actually knows how much debt is hidden in the dark. If Warsh begins to pull the Fed's liquidity out of the repo market, we could see a repeat of the September 2019 crisis, where interest rates in the overnight market suddenly spiked to 10%. When the plumbing of the system freezes, everything else stops. Companies can't make payroll. Banks can't process payments. The entire global machine grinds to a halt. The volatility we saw in gold and silver is just a preview of what happens when the shadow banks start to starve for dollars. Hedge funds that are over-leveraged in the gold market are the first to sell their most liquid assets when they can't get cash from the repo market. This is why gold crashed. It was not a judgment on the metal. It was a desperate cry for liquidity from a shadow banking system that is starting to realize the Fed is no longer their friend. According to analysts at JP Morgan, the systemic risk in the repo market is at its highest level in a decade. Warsh knows this, but he believes that the only way to fix the plumbing is to stop the leaks, even if it means the whole house gets wet for a while. To truly understand the Kevin Warsh factor, we have to talk about the Eurodollar market. Despite the name, this has nothing to do with the euro currency. Eurodollars are US dollars held in banks outside of the United States. They are the actual currency of global trade, used for everything from buying oil in Saudi Arabia to building factories in Vietnam. The problem is that the Eurodollar market is a giant pyramid scheme built on fractional reserve banking. There are far more dollar-denominated IOUs in the world than there are actual physical dollars. For the last 15 years, the Fed has provided the liquidity to keep this pyramid standing. When Warsh takes over and begins to harden the dollar, he is effectively pulling the base out from under that pyramid. As the supply of dollars shrinks, every country and corporation that needs dollars to pay their debt starts fighting over a smaller and smaller pool of currency. This is the Eurodollar squeeze. According to reports from the Bank for International Settlements, a squeeze in the Eurodollar market is often the precursor to a global recession. It forces foreign banks to sell their US Treasury bonds to get the dollars they need, which causes interest rates in the US to spike even higher. This is a vicious feedback loop that can destroy entire economies in a matter of weeks. Warsh understands this better than almost anyone. He was at the Fed during the 2008 crisis, and he saw how quickly the Eurodollar market could freeze up. But his philosophy has changed. He no longer believes the US should be the world's piggy bank. He is willing to let the global Eurodollar market collapse if it means protecting the domestic value of the American dollar. This is America First monetary policy, and it is going to be the most disruptive force in global finance for the next decade. The final target of the Kevin Warsh era is not the banks or the foreign governments. It is you. Specifically, it is the American middle class that has been lured into a life of debt by the promise of low interest rates. According to data from the Federal Reserve, the average American household is carrying more debt than at any other point in history. We have over $1.1 trillion in credit card debt and record high auto loan debt. This debt was manageable when interest rates were at 0 or 1%, but those days are over. If Kevin Warsh keeps interest rates high to fight inflation or to defend the dollar, the cost of servicing that debt will explode. We are already seeing credit card interest rates hitting 25 or 30%. At those levels, it is mathematically impossible for the average family to ever pay back the principal. They are simply paying rent on their own poverty. This is the middle class liquidation. The system is designed to encourage you to overextend yourself when money is cheap, and then to seize your assets when money becomes expensive. If you cannot afford your 7% mortgage or your $500 a month car payment, the bank will take the asset and sell it to a distressed debt fund. According to historical cycles, these periods of tightening always lead to a massive transfer of wealth from the many to the few. The people who have cash will be able to buy houses, stocks, and businesses for pennies on the dollar. The people who have debt will lose everything. Kevin Warsh is not the cause of this liquidation. He is the enforcer. He is the man who was hired to make sure the debt is paid, no matter how much it hurts. The rest of the world is not sitting idly by while the US weaponizes the dollar. The BRICS nations, Brazil, Russia, India, China, and South Africa, have already begun the process of de-dollarization. They understand that as long as they rely on the dollar, they are subject to the whims of the Federal Reserve and men like Kevin Warsh. According to reports from the Chinese Ministry of Finance, China has been aggressively selling its holdings of US Treasury bonds and replacing them with physical gold. This is the real reason why the demand for physical gold is so high even while the paper price is crashing. The East is preparing for a world where the US dollar is no longer the global reserve currency. When Warsh begins his tightening cycle, it will accelerate this process. The stronger the dollar gets, the more incentive other countries have to leave the system entirely. We are entering a new Cold War. But this one will not be fought with missiles. It will be fought with balance sheets and currency swaps. Trump and Warsh are betting that the US can win this war by making the dollar so scarce and so valuable that no one can afford to leave. It is a high-stakes gamble. If they are right, the US will maintain its global dominance for another 50 years. If they are wrong, they will trigger a global collapse that will bring the American empire to its knees. The volatility you see in your portfolio today is just the opening skirmish in this global conflict. The gold crash was the first shot. The rising interest rates are the second. The real war hasn't even started yet. So, how do you survive the Kevin Warsh era? How do you protect your family in a world where the Fed is no longer your friend? First, you must understand that the old rules no longer apply. The strategy of buy the dip worked for 20 years because the Fed always printed more money to push the market back up. That era is over. In a tightening cycle, the dip can keep dipping for a very long time. You need to focus on quality and cash flow. Do not buy companies that rely on debt to survive. Buy companies that actually produce things and have zero debt on their balance sheets. Second, you must recognize the difference between price and value. The price of gold on your screen is a reflection of the paper market and the margin requirements of the big banks. The value of gold is its role as the only form of money that cannot be printed by a central bank. If you own physical assets that are not someone else's liability, you are in a much stronger position than the person holding a digital IOU. Third, you must get out of high-interest debt immediately. In the era of Warsh, debt is a trap. The interest rates will not go back down to zero. You are in a race against the compounding interest that will eventually consume your entire income. Finally, you must realize that information is the only true currency in a time of crisis. The mainstream media will tell you that everything is fine or that the crash is a temporary blip. They are paid to keep you in the system until the big players have finished their liquidation. You have to look at the plumbing. You have to understand the repo market, the margin calls, and the Eurodollar squeeze. The Kevin Warsh factor is not just a change in leadership. It is a change in the laws of financial gravity. The party is over. The landlord is home. And the only people who will survive are the ones who saw it coming and had the courage to act. We are standing at the end of a long and dangerous monetary experiment. For 15 years, we have tried to solve our problems by printing more money and taking on more debt. We have created a world of artificial wealth and systemic rot. The nomination of Kevin Warsh is the signal that the experiment has failed. The United States is returning to a policy of sound money, not because it wants to, but because it has to. The alternative is a total collapse of the dollar and the end of American power. The transition will not be easy. It will not be cinematic. It will be a dry, technical, and painful process of liquidation. It will happen in the margin calls of the silver market. It will happen in the interest rate hikes on your credit card. It will happen in the bankruptcy courts and the shadow banking system. Your dollars are changing. Your gold is being tested. And the global economy is about to find out what happens when the easy money disappears and reality finally sets in. The system is not broken. It is functioning exactly as it was designed. It is a machine for transferring wealth from the people who don't understand the rules to the people who write them. By deconstructing the Kevin Warsh factor, you have at least a chance to move out of the way of the machine. Thank you for watching. If you want to understand the real story behind the headlines and learn how the global money machine actually works, make sure to subscribe and hit the notification bell. In the new era of the Federal Reserve, the only thing more valuable than your money is your intelligence.